All right, let's get straight to it. The U.S. markets are closed for the weekend, and as of the closing bell on Friday, November 7th, 2025, Pfizer, ticker PFE, ended the session at $24.43. This was a deceptively quiet close, up just a single cent or 0.04%. But that flatline price obscures the real story. The expectation is that this stock is dead money. But the reality is that an enormous battle is happening under the surface. The volume on Friday was staggering, clocking in at 118 million shares, more than double its average. That isn't retail indecision, that's institutional titans placing massive bets after a week of truly game-changing news. While everyone is chasing high flyers like Tesla stock or debating the valuation of Apple stock, they're missing the war for Pfizer's future that just went public. The common belief, the narrative that has crushed this stock 60% from its 2021 highs, is that Pfizer is a one-hit wonder. The COVID-19 vaccine and Paxlovid money is drying up, and the company is flying straight into a massive patent cliff with an empty pipeline. That's the expectation. And looking at the chart, you'd believe it. People see the 7% dividend yield not as an opportunity, but as a warning sign, a value trap, pointing to its high 90% payout ratio as proof it's unsustainable. They see the Q3 2025 revenue numbers released on November 4th, showing a 6% drop to $16.7 billion, and they run for the hills. But here is the reality that the market is just starting to wake up to. That same earnings report on November 4th wasn't the disaster everyone priced in. It was in fact a signal that the turnaround is already in motion. While revenue slightly missed, Pfizer's adjusted earnings per share came in at 87 cents. The consensus forecast, just 66 cents. That is not a small beat. That is a 32% positive surprise. It's a massive signal of intense cost control and operational efficiency. Even more important, management didn't just reaffirm its 2025 revenue guidance, it raised and narrowed its full-year 2025 adjusted EPS guidance to a range of $3 and $3.15. A company that is supposedly dying does not raise guidance. This is the disconnect. The market is looking at the past, while the company's financials are pointing to a more stable, non-COVID future. The truth is, the COVID-19 revenue decline has been masking the strength of the real Pfizer business. In that same Q3 report, the non-COVID product portfolio grew 4% operationally. Sales of the blood clot medication Eliquis were up 22%. The migraine drug Nurtec was up 22%. This is the core business, and it is healthy. The 118 million shares traded on Friday, that's big money at Fidelity and other major funds recalculating their models, realizing that the baseline business is far stronger than the stock price reflects. This isn't just a story for your individual brokerage account, it's a major institutional reevaluation. Now, let's talk about the real drama, the story that has active traders on the Robinhood app and SoFi Invest watching every tick. Pfizer is in a street fight for its future, and that future is the obesity market. For weeks, the narrative was that Pfizer had bungled its own internal GLP-1 weight loss drug development. The expectation was that they had missed the boat, leaving the entire $150 billion market to Eli Lilly and Novo Nordisk. But the reality is Pfizer is trying to buy its way in. They struck a $4.9 billion deal to acquire Metsera. This was their big move. But then, in a stunning hostile maneuver, Novo Nordisk, the 800-pound gorilla in the space, lobbed in a $9 billion unsolicited bid to snatch Metsera away. This is where it gets critical. On October 31st, Pfizer announced it had received early FTC clearance for its own deal, a huge win. But just days ago, Metsera's board, likely eyeing the bigger paycheck, deemed Pfizer's bid inferior to Novo's. In response, Pfizer hasn't backed down. It has filed lawsuits to block Novo Nordisk, calling their bid illusory and a clear-cut antitrust violation designed to kill a competitor in the cradle. This is high-stakes corporate warfare. Pfizer is using the cash it earned from the pandemic to secure its next decade of growth. This isn't a company just managing decline, it's a company at war, and that is what investors on platforms like Interactive Brokers are trading on right now. The outcome of this Metsera battle could be the single most important catalyst for the stock, far more than one quarter's earnings. While this M&A drama takes center stage, Pfizer is also doing the hard, painful work of cleaning its own house. On the same day as earnings, November 4th, the company announced it was axing 11 programs from its R&D pipeline. The headlines looked terrible: cutting assets from the $43 billion Seagen acquisition, cutting a MASH combo, cutting programs from the global blood therapeutics buyout. The expectation is that this is a sign of failure. The reality is that this is exactly what shareholders should want to see. It's aggressive cost discipline. They are pruning the branches that aren't bearing fruit to focus their capital. This is how they were able to raise EPS guidance. They are signaling to the market that they will not waste money on low-probability projects. They are focusing their R&D, likely on the high-potential oncology assets from Seagen and, if they win, the Metsera pipeline. So, let's step back and look at the company. Pfizer is a legacy biopharmaceutical giant. It's no longer the diversified conglomerate it once was. It's a pure-play, science-focused company. Its business model relies on developing and patent-protecting blockbuster drugs. The COVID-19 vaccines and treatments were an unprecedented windfall, but that windfall is now normalizing, and the market has punished the stock for it. Many long-term investors using Schwab Intelligent Portfolios or Fidelity Wealth Management hold this name for its dividend, and that brings us to the biggest, real risk: the patent cliff. This isn't a narrative, it's a fact. Between 2027 and 2028, key blockbusters like Eliquis, Ibrance, and Vyndaqel are set to lose their patent exclusivity. This is the real bear thesis. This is the cliff everyone is afraid of. The company's entire strategy right now, the cost-cutting, the 101 remaining pipeline programs, and especially the all-out war for Metsera, is about building a bridge to get over that 2028 cliff. This is the tension at the heart of the stock. The market is pricing in the risk of the cliff, but is ignoring the actions the company is taking to mitigate it. This is where online investment decisions are being made. Do you bet with the bears that they fail, or do you bet with the bulls that the Q3 earnings beat and the aggressive M&A strategy are the first signs they will succeed? For those of you looking at this on the Fidelity mobile app or considering SoFi stocks, the technical picture is still grim, which is where the bears get their confidence. The stock remains in a clear, multi-year falling trend channel. Technical analysts will tell you that resistance is firm around $26 and support is down near $21.60. The stock is broken. But the massive 118 million share volume on Friday on a flat day suggests a potential bottoming process. It's what you see when the last of the panic sellers finally unload their shares into the hands of large institutions who are looking 3 to 5 years out. This is a classic conflict between technicals, which look awful, and fundamentals, which are starting to improve. Here's a question for everyone watching. What do you think Pfizer's next move should be if they lose the Metsera deal? Comment below. Should they go after another target, or should they double down on their internal pipeline? Looking forward, the picture is one of high risk and potential high reward. The future outlook depends almost entirely on execution. Scenario 1. Bear case. They lose the Metsera battle to Novo Nordisk. The patent cliff looms, the 7% dividend is cut to conserve cash, and the stock languishes in the low $20, becoming the very definition of a value trap that holders of Fidelity mutual funds or Fidelity ETFs are warned about. Scenario 2, bull case, they win the Metsera lawsuit or find another way to secure a position in the obesity market. The cost-cutting plan continues to boost profitability, allowing them to defend the dividend. The non-COVID portfolio continues to post solid 4 to 5% growth, and 1 or 2 of the 30 Phase 3 trials in their pipeline hit. This is the case where the stock is profoundly undervalued. Investors who buy now, whether through self-investing platforms or an intelligent portfolio, will be rewarded as the market reprices the stock from a dying company to a turnaround story. This is the kind of investment help people are looking for, identifying the gap between perception and reality. This stock is a world away from the momentum-driven narratives of Nvidia stock or Robinhood crypto trading. This is a deep, fundamental investment thesis. So, to wrap it all up, the expectation for Pfizer is that it's a fallen angel, a COVID-19 relic with a terrifying patent cliff and an unsustainable dividend. The stock chart certainly screams danger, but the reality, when you look at the just-released Q3 data, is a company that beat earnings by over 30%, raised its profit guidance for the year, is showing growth in its core business, and is fighting a bare-knuckle brawl to secure its next decade of growth. The 118 million share volume day tells you that the smart money is no longer ignoring this. The market's expectation is lagging the new reality. The question for anyone doing their online investing is no